Hello and welcome to this week's special presentation. My name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's topic, which is titled Strategies for a Successful Retirement Portfolio, Part 2. This follows my colleague Brian D'Amico's presentation a couple of weeks back, where he did Part 1 for Successful Retirement Portfolio Strategies, and he referenced and revisited the great compilation of strategies from our founder, Dr. Bart DiLiddo. And what I'd like to do today is just take that to the next step and look a little deeper and revisit some of the ideas and concepts that Dr. D talked about back in September and October of 2009. Remember, you can go to vectorvest.com/retirement essays to download that collection. Let's go ahead and jump right into that download of the strategies for successful retirement. These essays from Dr. DiLiddo were really the genesis of the retirement services department here at VectorVest, and it all began when Dr. D responded to an email he had received from a customer back in September of 2009, and it was all based on the situation of that customer. And he talked about being retired for a few years and how in the 2007-2008 financial crisis, his retirement portfolio was drawn down to about $500,000 from about $650,000 that he had in his portfolio. So he was reaching out to Dr. DiLiddo to talk about how he can put together a prudent strategy, and his goal was to generate 10% annually with some reliability. He went on to say it could be dividend stocks combined with growth, okay, as long as they followed the VectorVest market timing indicators. And he went on to ask Dr. D, what approach would you take? And no one better to ask for that advice. And so what I'd like to do is talk a little bit about Part 1. Brian alluded to it, and we'll talk a little bit about it, and then I'll go into some ideas that we are currently using in VectorVest in our retirement courses, in our retirement coaching group, all based on the foundation that Dr. DiLiddo created back in 2009. Again, this is a $500,000 portfolio. It's a template, so naturally you would use whatever assets you're allocating to the equity markets to build around this. But for our example, it's a $500,000 retirement account, and Dr. D started with the first two parts. So $200,000 of that, those assets would go into relatively safe bond funds that were paying about 6% interest. Okay, later on, Dr. D talked about how to go in and find those bond funds. And if I just go into the VectorVest program for just a moment, I can give you an idea on how to find those in the VectorVest program. So I'll start by going to the industry viewer, or actually the sector viewer. Then I'll go ahead and double click on ETFs, and that will bring up all of the different industries under ETFs. And so from here, you can go down to fixed income. There's fixed income other, there's fixed income treasury. If I double click on fixed income other, it will bring up a lot of ETFs that have safe fixed income underlying assets here. One thing you'd want to do when looking at this list of income ETFs, you'd want to come over, and I would strongly suggest you sort by volume. Make sure you have volume. There's so many of them don't trade very much, and do a little research, but you can go through and find these higher yields, these dividend yields that you're getting. The dividend paid is here, but that's just one way to do some research on those. I just wanted to share that as a process that Dr. D shared to be able to get into those ETFs. Okay, which brings us to the first of the portfolios he would create after putting that 40% of this $500,000 into safe bond funds. And there are other ways to find those funds, and you can do some research on that. Now, the first of the portfolios he talked about creating to help our customer meet his goals had to do with what he called Vector plus Vector. The portfolio would be based upon the Vector plus Vector strategy within the VectorVest program, which is ideally suited for retirement portfolios. It finds stocks with the best combination of VST Vector for capital appreciation and the YSG Vector for current income. So what I'd like to do is go back into the program and take us into the Unisearch tool to discuss the search that Dr. DiLiddo was talking about. Again, the idea being that he wanted to be able to go out and find good quality stocks and have the ability to sell covered calls against these stocks as well. So when I come into the retirement searches folder within the Unisearch tool and I scroll down, I can see high VST plus YSG stocks. This is what Dr. D was referring to, the search. Now, first of all, the sort, it takes the best combination of value, safety, timing, that's the analysis of the underlying stock, as well as the VectorVest analysis of the dividends, yield, safety, and growth. So the best combination of those come to the top of the list. The stock has to have a VST greater than or equal to 1. The stock's YSG, or that yield, safety, growth vector, has to be greater than or equal to 1. And we're looking for safe stocks here. So Dr. D set relative safety at greater than or equal to 1.25 on the 0 to 2 scale. And then finally, the growth rate, right? The earnings growth rate had to be at least 10% per year or greater. And then there's some other basic indicators that were here. So if I go ahead and run that search right now, you can see that we are looking for dividend paying stocks, safe dividends, dividends that are growing. And if I scroll over just a bit, we'll come to the VectorVest analysis of these stocks. So you can see relative value and safety. Anytime you see relative safety up above 1.25 or higher, generally what's going to happen are all the other numbers that I care about, like relative value, which is price appreciation potential, like earnings growth rate. And for dividend paying stocks, that dividend safety is going to be there as well as the growth. And so overall, these are all very good stocks, again, sorted by the highest combination of VST plus YSG. And Dr. D used this search for both growth and dividend income, with the concept behind it that you can also sell covered calls to generate even more income to meet the goals that our subscriber had laid out. So the concept or the idea that we're looking for both capital appreciation in the underlying stocks as well as the dividend payouts, coupled with the ability to sell covered calls against these stocks, you'll see they are all optionable stocks. And so we have the ability to go out and sell covered calls, and Dr. D would use the process of selling out of the money covered calls to continue to generate the income on top of the dividend payouts and the yields that we see. If I then begin to scroll down, and I'll come to part 2 of the series of Dr. D's essays. It was written back on September 25th of 2009. He begins by reviewing what he began with the vector plus vector strategy, or the high VST plus YSG stocks. I showed you where to find those in the Unisearch tool. And he then went on stating that he needed to generate an additional amount of income per year for the remaining portion of those asset allocations. Dr. D went on to say in the second $100,000 portfolio, his aim here was to generate most, if not all, of the $11,500 per year of current income directly from dividend payments. This means I must select high dividend yield stocks that are reasonably reliable. And so he created a strategy called high yield 2x10s. And he goes on to talk about the 2x10s, and he emphasizes that you shouldn't jump into any of these stocks without thoroughly checking into them. Moreover, I would not buy more than one of these stocks in any single industry group, and no more than 2 stocks from any business sector. So that's part of the investment plan that you have to take into account. If I go back into the Unisearch tool, I'll share these searches that Dr. D talked about again. This is the high yield 2x10s. And as he noted, you have to be careful with these type of stocks. They do have a very high yield. For these stocks, the dividends are paid out. Some of them are REITs, some of them might be MLPs. There are different sectors and industries you have to be careful about, and make sure you don't overload any one sector or industry. So there's some great candidates there to put into your portfolio. And in the essays, Dr. D also alludes to the fact that, you don't have to just automatically populate, a full 10 stock portfolio with these stocks. You can begin to add 1 or 2 or 3 at a time, and perhaps mix them with some others. So some good candidates here that Dr. D had talked about. in part 2 of his retirement essays. The following week, Dr. D wrote an essay titled Double Juicy, and his goal here in the final portion of the portfolios he was creating talked about generating the income that he needed to generate. In his words, he needed to find a way to make at least $11,500 based on our customers' numbers for the final $100,000 that was left to invest. And he said, I believe the surest way of doing this is by selling covered calls on high yield stocks. Basically, I'm going to combine the techniques I plan to use in managing the two $100,000 portfolios. And that's a key phrase here. I'm going to combine the techniques I plan to use in managing the $100,000 portfolios. Dr. D went on to talk about another search he had created, optionable 2x4s, and all of the information on that search is here as well. And that's found also in the retirement portfolio. So let's take a moment to recap where we're at when we're talking about allocating your assets for successful retirement portfolio strategies. We're looking at this $500,000 retirement portfolio. Again, you fill in the number that suits your net assets, and here's where we're at so far. Relatively safe bond funds. Now, Dr. D talked about paying 6%. Some of those ETFs pay that. There's MLPs out there. There's closed-end funds where you can go that are safe income producing ETFs or funds. Whether right now you'll get 6%, you have to wait and see, but you can do some research on that. So that is the safety portion of that. Next, Dr. D talks about safe stocks plus dividends plus the power of selling covered calls against those. That was in Portfolio 1. Portfolio 2 talked about reliable high dividend yield stocks. And then finally, Portfolio 3 was all about selling covered calls on high yield stocks. You can see a pattern here. We're talking about the portion of your retirement portfolio, how you can be successful if your goal is to generate a safe, steady income using your retirement assets. Okay, so that is the concept here, what that Dr. D is talking about, and it has that same thread in common throughout all of those strategies. So with that in mind, I'd like to go back into the program and share with you a strategy that you can use that, again, we teach in our retirement courses, we use in our retirement coaching group, that is based on these ideals that Dr. D wrote about. And it begins in the retirement folder. And I'm going to pull up a search. We'll start here in the Unisearch tool called Blue Chip Dividend Payers. Now, I was doing a special presentation, must be at least 5 years ago, 6 years ago now, I'm not real sure, that and Dr. DiLiddo actually helped me create this. I talked to him for a while. We were on the phone discussing searches and strategies for our retirement investors. And so I had relayed to him that I wanted to create a good quality dividend portfolio and a good stock dividend safety. And I had spent a while trying to figure out a payout ratio, trying to build a parameter here. And you know, Dr. D just kind of laughed at me and he said, James, just use dividend safety. It's built right into the program. It's on a 0 to 99 scale. So dividend safety has to be greater than or equal to 50 on that 0 to 99 scale. What that did was ensure a favorable payout ratio when you compare earnings to the dividend or earnings yield to dividend yield. But it's a pretty straightforward search. I just wanted stocks from the industrials, transports, utilities, and the S&P 500. So companies we're familiar with, mature, high cash flow, strong cash flow companies. The dividend yield had to be at least 3% or greater. As we saw in high VST, YSG stocks, wonderful stocks, but some of those yields were a little perhaps lower than we'd want. And then we took from the stock watch list, these pre-built lists within the VectorVest program. They're called the DRIP 10 to 24 and the DRIP 25 plus. DRIP is the dividend reinvestment plan. It means all of these stocks can automatically have their dividend payouts reinvested. And all this tells me is that every stock that comes up on this list has not only paid but has grown their dividend for at least the last 10 years, and of course 25 plus for the DRIP 25 watch list. And then we know we're going to get this safe dividend payout. Finally, the sort, right? The earnings growth rate times the dividend growth rate. And that's very important because a company needs to grow their dividends. That's what we're looking for, companies that grow their dividends. And companies without a strong free cash flow or strong earnings growth rate is not going to be able to do that. So when I click the run search button, it's going to show us bringing back just the top 10 stocks here. And you can see right now some hold, some buy rated stocks. Some of the things that stand out when I scroll over just a little bit here is the earnings growth rates and the dividend yields. Right now, again, you'll recognize, I'm sure, all of these companies. These are mature, well-known companies, very high relative value numbers. You'll notice the relative safety numbers are not, really strong. Most of them are above 1, just one of them below. But remember, these are not your basic growth companies here. However, I will show you the capital appreciation potential that you get, because you do see very high relative value numbers here. If I continue to scroll over, let's take a look at the dividend information. So again, the yield has to be at least 3% here. When we look to combine the concepts that Dr. D was talking about, that's how was the goal of this particular search and investment plan that Dr. D helped me develop here, was kind of getting all of those ideas of good, strong dividend payout, as well as the ability to sell covered calls against these. So we have a nice dividend yield. The safety on these stocks is good. The dividend growth rate all strong, and the earnings growth rate strong. Now again, we would use the same concept found in the essays, that we wouldn't buy any more than 2 of these stocks per sector to be sure that we don't have too much exposure in any one industry or sector. Let me just show you a portfolio that we use again in our retirement coaching group, blue chip dividend payers. This is a model portfolio. It began as a back test way back in 2013 or 14, and then I converted it into a model portfolio. And you can see currently up today, it's up over 168.5% since January of 2013. I like to use a little bit longer term for our dividend portfolios, because that's really what we're looking at, right? This longer steady income approach. What we see here are stocks and just recently repopulated on the most recent confirmed call, because there are risk management techniques that had us back in 2020 fully in cash. And then if I make this equity curve a little bigger, of course, you're going to see some drawdown in these volatile markets that we had. We also have ways of mitigating these drawdowns by protecting your portfolios. I'll comment on it a bit, using insurance such as protective puts. Now, the key to looking at this equity curve and the type of stocks we have in here is to understand this. This 168.5% return does not include the dividend payouts that we would have gotten. So this is just capital appreciation. What doesn't show here is the over $60,000 of dividend payouts we've taken in over the course of the life of this portfolio. And even that doesn't include the reinvesting of those dividends if you choose to. So here I have the ability to go in, and I just want to share with you, again, the results of this portfolio. And what you see here is the overall gain. The total commission is based on $1 commission rate, just so I can count the number of trades. You're averaging here for round trip trades about 90 trades throughout over 8.5-year period. So not a lot of trading or activity going on there, based on the prudent risk management techniques we already have in place. Only on the capital appreciation gives you 17.5% annualized rate of return. That's the average return. The compounded rate of return, kind of a more realistic number, is just about 11%, just under 11%. Okay, keeping in mind this doesn't include the dividends, and it certainly doesn't include the ability of selling covered calls against these as well. So when we look at this portfolio, it's really up about 22-23% annualized rate of return with that nice steady flow. And again, that doesn't include the ability to sell covered calls. My goal here in this presentation was to simply share with you the power of the concepts that Dr. D wrote about back in 2009, and being able to simply find good quality stocks that pay a safe dividend that you are also able to sell covered calls against to continue to add to that income. Now, our customer was looking for 10% return back in 2009, and just this portfolio alone is averaging over 22% annualized rate of return. And then one final point I'd like to make for today's presentation is the essay that came on October the 9th, 2009, talking about managing your retirement stocks. So again, I urge you to read through all the essays. It's fantastic reading here, but I've highlighted what Dr. D wrote back then. My biggest concern regarding the idea of managing stocks for current income is that of losing sight of capital preservation. In other words, you may become so intent on capturing a dividend payment that you end up holding stocks that you should have sold. Consequently, you will lose a lot more money than you could have possibly made in current income. Don't let that happen to you. Capital preservation should be your top priority. Okay, so a very important concept when it comes to building and managing your retirement portfolio. Now, I talked about these drawdowns that we see in this portfolio. In our retirement coaching group and in our retirement course, we talk about buying insurance policies. In other words, using protective puts strategically placed to defend your net worth. Okay, so understand that the proper risk management techniques, the proper stop criteria and money management that we put into these is a big factor in your success. So I would urge you to go ahead and go to the VectorVest.com/retirement essays link there. Download this wonderful collection of essays from Dr. DiLiddo. And if you would like to learn a little bit more about how you can successfully build and manage your retirement portfolio, I'd like to introduce you to our Retirement Portfolio Transformation course. It's a step-by-step roadmap to a secure retirement. In this course, you will walk through 5 different modules that we have set in the VectorVest University. We'll talk about setting clear goals in Module 1, keeping in mind the old saying that, a goal without a plan is just a wish, right? So if you're looking to plan to build and manage your retirement portfolio, you need to have goals in place and a plan to get there. And we'll do that. In modules 2 and 3, we'll walk through all of the important concepts of building a safe growth portfolio for capital appreciation. We'll talk about in more detail the dividend growth portfolio, the ability to sell covered calls against your positions to generate income. We'll talk about selling puts for income as well. And we'll delve much deeper into how to manage these portfolios. And as I said, rule number 1 to your retirement portfolio management has to be that you don't lose money, okay, or that you mitigate those losses and you understand eliminating risk and mitigating those drawdowns that we see. Can we always do it dollar for dollar? No, but we can insure our portfolios to make sure that those drawdowns are managed properly. So if you go to VectorVest.com/transform, it will bring you to this page where you can learn more. You can enroll and get our early bird special at $5.95. You've got till Monday at 5 o'clock for that. If you scroll through here, it'll go into great detail what the course will offer you. And so I urge you to read through that and consider joining us so that you can begin to implement the strategies for a successful retirement portfolio.